Welcome to the world of Forex, a term that might sound complex but something you likely encounter every day. Forex is short for foreign exchange. It is the global marketplace where national currencies are traded against one another. Imagine traveling from the United States to Japan. You exchange US dollars for Japanese yen. That simple exchange is part of the massive Forex market. It is not a centralized market like a stock exchange. Instead, it's an electronic network. Banks, brokers, institutions, individual traders, all connected and operating across the globe. This decentralization lets it run continuously, making it unique and dynamic. The sheer scale is staggering. It's the largest financial market in the world. Daily trading volume exceeds $6 trillion. That dwarfs the volume of the world's stock markets combined. This liquidity means you can usually find a buyer or seller for major currencies. Activity is driven by international trade, global investments, tourism, speculation. For beginners, grasping this scale is the first step to understanding opportunities and risks. The marketplace runs around the clock, 5 days a week. As one financial center closes, another opens. Sydney, Tokyo, London, New York. This 24-hour cycle means currency values constantly fluctuate with economic news, political events, and market sentiment worldwide. That continuous nature gives traders flexibility to trade when it suits them, but it also requires vigilance. Prices can change in an instant, influenced by events thousands of miles away. Why does this matter to you? Forex matters beyond travel currency conversion. It's the bedrock of international commerce and the global economy. Exchange rates affect prices of imported goods. They affect profitability of multinational corporations. They influence interest rates set by central banks. By learning Forex, you aren't just speculating on prices. You're understanding the connections that drive the world economy. It's a journey into the heart of global finance, showing how countries and economies interact daily. The allure of Forex trading is powerful and multifaceted, drawing in millions of aspiring traders from all walks of life. One of the most significant attractions is the market's accessibility. Forex can be started with a relatively small initial investment. The rise of online brokers has democratized trading, allowing anyone with an internet connection to open an account from home. That low barrier to entry plus the potential for significant returns paints a picture of financial freedom. The dream, being your own boss, earning from your analytical skills. Another major draw is leverage. Leverage lets you control a large position with little capital. For example, a 100:1 ratio lets you control $100,000 with $1,000 in your account. That can dramatically amplify profits from small price moves. Turning a small investment into a substantial gain is tempting. High liquidity makes entering and exiting trades easy and fast, but balance this allure with reality. The same leverage that magnifies profits can magnify losses. A small move against you can wipe out your investment in minutes. Accessibility means many start unprepared. They're swayed by marketing promising easy riches. They overlook that success requires skill, strategy, and emotional control. The reality, a vast majority of new traders lose money. This isn't to discourage you but to ground you. Forex is not a get-rich-quick scheme, it's highly competitive. You're up against seasoned professionals, large financial institutions, and sophisticated algorithms. Success comes from education, diligent practice, robust risk management, and developing a resilient trading psychology. Acknowledging this reality is the first and most important step. Given the high risks involved, embarking on your Forex journey with a conservative mindset is essential for survival and for long-term success. A conservative approach prioritizes preserving your trading capital above all else. Instead of chasing fast, spectacular profits, focus on steady, consistent gains while minimizing losses. Start small in capital and in trade size. Learn to walk before you run. This method gives you the most valuable asset: time. Time to learn, time to practice, time to gain experience without losing your account early. Commit to education. Before risking real money, immerse yourself in the fundamentals. Understand key concepts like currency pairs, pips, spreads, and leverage. Learn to read price charts and use basic technical indicators. Learn fundamental analysis. Economic data releases, central bank policies, geopolitical events, and how they affect currencies. Use broker resources, educational content, webinars, and demo accounts. Practice on a demo account with virtual money in a real market. Apply risk management. Define rules to protect yourself from big losses. Always use a stop-loss order. A stop-loss automatically closes a trade if the market moves against you, limiting your loss on that trade. Use proper position sizing. Risk only a small percentage of capital per trade, typically 1–2%. This prevents a string of losses from wiping out your account so you can wait for winning opportunities. Build a solid foundation. Develop good habits from day one. Create a detailed trading plan that outlines your strategy, risk rules, and goals. Keep a trading journal to track trades, review performance, and learn from successes and mistakes. A disciplined, patient, methodical approach may not be flashy, but it's the safest way to navigate Forex. It gives you the best chance of becoming a consistently profitable trader long-term. At the very heart of Forex trading lies the concept of the currency pair. Unlike stocks or commodities, in Forex you always trade one currency against another. That's why currencies are quoted in pairs. Think of it as a tug-of-war between two national economies. When you trade a pair like the EUR-USD, you buy one currency and sell the other. The first currency, here the euro, is the base currency. The second, the US dollar, is the quote currency. This pairing structure is fundamental. The price tells you how much quote currency buys 1 unit of the base. Example, EUR-USD at 1.0850 means 1 euro equals sign 1.0850 US dollars. Buy the pair equal sign, you expect the base euro to strengthen versus the quote USD. Sell the pair equal sign, you expect the base to weaken versus the quote. This dynamic drives every Forex trade. Currency pairs are grouped: majors, minors, exotics. Majors, most traded and always include USD, EUR, USD, GBP, USD, USD, JPY, known for high liquidity and lower costs. Minors, crosses, exclude USD, EUR, GBP, AUD, JPY. These pairs are liquid but can be slightly more volatile than majors. Exotics, one major plus, one emerging market currency, USD, ZAR, EUR, less traded, wider costs and more volatility. For beginners, focus on 1 or 2 major pairs to trade more safely. To trade effectively, you must understand Forex market prices. A currency pair quote shows 2 prices, the bid and ask. The bid is the price at which you can sell, and the ask is the price at which you can buy. The spread is the difference between these prices and represents the broker's fee. A pip, or percentage in point, measures price change. For most pairs, it's the 4th decimal place. For yen pairs, it is the 2nd. Understanding these terms is essential for reading the market. Leverage lets you control a large amount of money with a small amount of capital known as your margin. Leverage is expressed as a ratio like 50 to 1 or 100 to 1. With a ratio of 100 to 1, $1 controls a $100 position. Leverage can amplify profits, but it's a double-edged sword. It can amplify losses just as quickly. Beginners should be cautious and use low leverage. Focus on risk management to protect your capital. The Forex market is not a monolithic entity. It is a dynamic ecosystem of different participants. Each has its own objectives and influence. At the very top are central banks: US Federal Reserve, European Central Bank, Bank of Japan. These institutions are immensely powerful. They manage monetary policy, they set interest rates, they control the money supply. Their decisions and public statements can cause massive immediate shifts in currency values. They don't usually trade for speculative profit, but they may intervene to stabilize their currency or to achieve specific economic goals. Below central banks are major commercial and investment banks. These giants form the interbank market where most Forex volume occurs. JP Morgan Chase, Deutsche Bank, Citigroup. Banks facilitate transactions for large corporate clients. They exchange currencies for international trade. They handle currency needs for investment. Banks also trade speculatively for their own accounts, using teams of professional traders, using highly sophisticated technology to profit from price movements. Their sheer transaction volume drives currency prices moment to moment. Their actions provide the liquidity the market relies on. Another group is large multinational corporations. Companies operating in many countries face constant currency risk. Example, a European company selling in the United States. It receives payments in US dollars. If the dollar weakens against the euro, profits fall when converting back to euros. To protect themselves, corporations hedge in the Forex market. They enter currency transactions to lock in a favorable exchange rate and reduce uncertainty for future payments. Their trading is defensive, not speculative. Finally, at the base of the pyramid are retail traders. Individuals like you and me who speculate for profit. Retail volume is small compared to banks and corporations, but the number of retail participants is vast and growing. Retail traders access the market through Forex brokers. Brokers connect them to the larger interbank market. As a retail trader, remember you're a small fish in a very large pond. Understanding larger players' motivations gives valuable context for your trading decisions. The Forex market is unique because it's open 24 hours a day. Unlike stock markets, Forex is decentralized. Trading flows continuously from Wellington to New York, creating activity throughout the week. This non-stop cycle is possible because of different international time zones. Currency prices are constantly updated, providing flexibility for traders. The market can be influenced by events that occur while you are asleep. Use protective orders like stop losses to manage your risk. Understanding this cycle is fundamental because the market's character changes throughout the day. The 24-hour Forex trading day is divided into 3 main trading sessions, named after the major financial centers: Asian, Tokyo European, London North American, New York. Smaller centers like Sydney open first, but these 3 drive most global trading. Each session has distinct characteristics that help you anticipate market behavior. Think of it like rush hours on a highway. The day kicks off with the Asian session in Tokyo, influenced by Hong Kong, Singapore, and Sydney. Asian hours tend to be more subdued, thinner liquidity and choppier moves. Most active pairs then often involve the Japanese yen, Australian dollar, New Zealand dollar. As Asian hours wind down, the European session in London begins. London is the world's largest Forex center, and when it opens, liquidity and volatility surge. The market gets much more active and trends can form. Pairs with the euro, British pound, and Swiss franc become prominent. London often sets the major trends for the day. Next is the North American session centered in New York. It's highly liquid and volatile, especially during the overlap with London, often the busiest period. The US dollar dominates, and major US economic reports at session open can move markets sharply. After the London close activity eases, markets stay active until the New York close, then a quieter period leads into the next Asian day. While Forex is a 24-hour market, not all times are equal. Trade when the market has high liquidity and high volatility. Optimal times occur when major sessions overlap, like London and New York. Be aware of economic data releases. The best time depends on your style and pairs. As a beginner, observe the market during different sessions using a demo account. Build your schedule around high opportunity windows. Your broker is your gateway to the Forex market. Choose wisely. Regulation is non-negotiable. FCA, ASIC, CFTC, compare trading costs. Tight spreads, transparent commissions. No hidden fees. Test the trading platform with a demo account. It should be stable, intuitive, and offer all necessary tools. Prioritize brokers with responsive customer support and quality educational resources. A reputable broker supports your growth, not just your deposits. Start with a demo account. Trade real markets with virtual money, risk-free. Use it to master the platform test strategies. Build trading discipline. Treat demo trading seriously. Use realistic amounts, strict risk management. Keep a journal to track your progress and refine your approach. Only move to live trading after consistent demo success over several months. The demo phase is your training ground. Don't skip it. Ready for live trading? Open an account online with your chosen regulated broker. Complete identity verification. Fund your account using a secure, convenient method. Start small. Only risk what you can afford to lose. Stick to your proven trading plan. Use the smallest position sizes at first. Focus on protecting your capital, building confidence, not chasing big profits. The goal, steady progress, not instant riches. Success depends on your ability to analyze the market and make informed decisions. Learn the basics of fundamental analysis, economic news. Learn the basics of technical analysis, chart patterns. Start with simple technical tools like candlestick charts and moving averages to identify trends. Combine both analysis types for a balanced approach. Use fundamentals for bias, technicals for timing. Don't overwhelm yourself. Master 1 or 2 concepts before expanding your toolkit. Build your skills step by step for long-term growth. Scalping means making many quick trades for small profits exciting, but demanding. It requires tight spreads, fast execution, and intense focus. Best suited for experienced traders. Scalpers rely on technical indicators, strict rules, there's no time for hesitation. High transaction costs and emotional stress make it risky for beginners. Understand scalping, but start with slower-paced strategies as a conservative trader. Build experience and discipline before considering high-frequency trading. Day trading involves opening and closing positions within a single day, avoiding overnight exposure. By the end of the New York session, their account is flat. Day traders aim to profit from intraday price movements, relying heavily on technical analysis to identify opportunities. Awareness of the economic calendar is crucial, as news releases can drive significant volatility. Successful day traders plan their day in advance, noting key times and potential market-moving events. Risk management is paramount. Strict stop-loss orders and defined profit targets are essential. Swing trading is a medium-term strategy between day trading and position trading. Swing traders aim to capture larger price swings over a few days to weeks. They identify a developing trend and ride it until reversal signs appear. Requiring less screen time than day trading, it's popular for those with other commitments. Analysis often involves 4-hour or daily charts, spotting significant support and trends. Swing traders use both fundamental and technical analysis. Patience is key. Wider stops accommodate volatility, targeting larger profits. Swing trading is suitable for beginners, offering more analysis time and reduced stress. Focusing on higher time frames helps see the market clearly. It provides a framework for risk management and developing essential discipline. Position trading is a long-term strategy where trades last weeks, months, or even years. The goal is to profit from major long-term trends, more like investing than trading. It requires in-depth analysis of macroeconomic fundamentals. Position traders study economic factors like central bank policies and long-term growth. Wide stop losses are needed due to market volatility, requiring small position sizes. This strategy suits those with patience, an interest in global economics and busy schedules. The most fundamental risk in any form of trading, including Forex, is market risk. This is basically the risk that your trade will lose value just because the market moves in the opposite direction of what you predicted. Currency prices are always in a state of flux, influenced by a whole bunch of factors that are often unpredictable. A sudden political announcement, an unexpected economic data release, a shift in broad market sentiment. All of these can cause prices to move sharply and suddenly against your position. This risk is just part of trading. It can't ever be completely eliminated. Every single time you enter the market, you're accepting the possibility that the trade could result in a loss, a reality you have to embrace. Market risk is amplified by volatility. Volatility is the magnitude and speed of price changes. Volatility creates profit opportunities because a static market offers none. But high volatility also significantly increases your risk. During periods of high volatility, like around a major news release, prices can swing wildly in both directions. That makes it really tough to trade with any certainty. A position can move from profit to a substantial loss in seconds. For beginners, these extreme periods are often the most dangerous to trade. It's like navigating a small boat in the middle of a hurricane. Disaster potential is high. This risk isn't just being wrong in your analysis. Even a well-analyzed high-probability trade can still fail. The Forex market is complex with millions of participants. No one predicts it with 100% accuracy. Sometimes the market simply won't behave how your analysis expects. That's a normal part of trading. The goal isn't avoiding losses, that's impossible. It's keeping losses small and manageable. Acknowledging losses are inevitable is the first step to psychological resilience for long-term survival. To protect yourself, never trade without a predefined plan. Before entering, know exactly where you'll exit if the market moves against you. That's the role of the stop-loss order. More on that later. A preset exit removes emotion and prevents small losses becoming catastrophic. Respect the market's power. Never assume you know what's next. Stay humble. Be prepared for any outcome. Always prioritize protecting your capital over chasing potentially large, uncertain profits. Leverage is a double-edged sword, so it deserves its own dedicated section on risk. Leverage risk is the danger that comes from using borrowed capital. High leverage is one of the fastest ways to lose your entire account. Excessive leverage dramatically shrinks your margin for error. High leverage can lead to a margin call. This often happens at the worst possible time, locking in a significant loss. The solution is to use very low leverage by trading with small position sizes relative to your account balance. Always remember that your first job as a trader is to manage risk. Beyond market risks, there's counterparty risk, primarily your broker in Forex. You entrust them with capital, relying on fair order execution and fund access. Broker failure, though small with good brokers, can happen due to insolvency or fraud. Choose well-regulated brokers like those under FCA or ASIC, with segregated accounts to protect your funds. Ensure fast, reliable trade execution to avoid slippage. Research brokers, check regulatory status, and test withdrawals before depositing large sums. Now, let's focus on practical risk management strategies. The most important tool is the stop-loss order. It's your safety net, automatically closing your trade at a predefined level, limiting potential losses. Another critical tool is position sizing. Beginners can use the 1% rule, risking no more than 1% of your capital on a single trade. Also, consider the risk-to-reward ratio. Aim for trades where potential profit is at least twice the potential risk. Finally, keep a trading journal. Regularly review it to analyze performance, identify mistakes, and refine your approach. We've covered a lot, from understanding the Forex market to currency pairs, pips, spreads, and leverage. We discussed choosing a regulated broker, practicing on a demo account, and different trading strategies. Risk management is key. Use stop losses, proper position sizing, and aim for a positive risk-to-reward ratio. This conservative approach prioritizes steady growth. Commit to continuous learning to think like a trader. As you stand at the beginning of your Forex trading journey, it is completely normal to feel a mix of excitement and apprehension. The path ahead will be challenging. It will demand dedication, discipline, a persistent desire to learn. There will be days when the market seems to make no sense. You will inevitably experience losing trades. Every successful trader has faced these same obstacles. Losses are not failures. They are tuition paid to the market. Keep those lessons affordable by keeping risks small and manageable. The journey is a marathon, not a sprint. Success won't come overnight. Measure progress in months and years, not days and weeks. Celebrate small victories. Stick to your trading plan for a full week. Even if the gains are modest, keep a trading journal. Review it objectively. Disciplined execution plus reflective learning builds skill and confidence. Every trade is an opportunity to improve. You control the most important factors. You can't control where the market will go next, but you can control your preparation, your strategy, your entry point, your exit point, and your risk. Focus on perfecting your process. Profits will follow. Stay curious. Read books. Watch videos. Never stop seeking knowledge. The market evolves. Be a lifelong student. Education gives you an edge. Take these steps with optimistic realism. The Forex market offers opportunities for those who trade with respect, discipline, and a plan. Adopt conservative principles. Give yourself the best chance to survive and thrive. Your trading future is a blank chart waiting to be filled. Make your first mark with caution, fill the page with discipline, aim for a long, successful story. We wish you the very best of luck. Happy, safe trading.